All right, then let's get started. So, take us at the course of last class, we discussed about market structures and all that. I think we talked about basic market structure, complex market structure. As for the advanced market structure, we'll be talking about it after we're done taking liquidity. So, before that, let's go back to market mechanics. So, today, we'll be talking about market mechanics, introduction to market mechanics. That's basic market mechanics, and we're talking about the introduction to market mechanics down to the definition of market mechanics or what market mechanics is all about based on different concepts. So just a moment, I'm coming. Okay. So now, what exactly is market mechanics? We have been studying the market probably a little bit since this is an advanced class. I expect everyone here to must have studied the market at one given point in time. So you will know exactly, like you have tend to wonder why price is even moving in the first place. Why is the market moving? Why is it that the market is not even constant in one place? Price is always fluctuating and all that. Where is price even going to? What exactly is making this particular thing to function? Just everything, all those theories, all those kind of things that you cannot explain by yourself. That is the mechanism of the market. For you to be able to understand those things, you need to understand first of all the mechanism of the market, and that's why we take market mechanics. And market mechanics is just basically like why, what, like why is price moving, where is price going to, where is price coming from, what is making price to move, what is making the market and all that to move. That's basically what market mechanics it is. Why is the market moving? Where is the market going to? Where is it coming from? Which level are we in the market currently? All these ones are basically what we want to be looking at for in market mechanics. And to explain this, we make use of two concepts, all right? Or rather, I make use of two concepts, in which the first one being the concept of supply and demand. I always use supply and demand because this our trading is something relating to economics as well. Because we are first of all analysts before becoming what? A trader. If you're not good at analyzing, then just know saying that trash and you won't go do for trading. So you first of all be an analyst before you can then be a trader. And to become a good analyst, basically it's just to become a good economist, right? The two are almost similar, just that an analyst tends to focus more on analyzing the charts, by an economist is focusing much more broader subjects, much more broader stuffs, right? So that's for that. So, like I said, we make use of two economical distinguishes the concept of supply and demand. That is the first one we're going to be using. And the second one is the smart money concept. All right. That's where we talk about the SMC itself, the SMC I've been about. But before that, let's talk about the concept of supply and demand using into that's market mechanics based on supply and what's demand. Now, for that, what is supply and demand in the first place? Now, going with the first one, supply, or let me just go with the one that we are all familiar with, demand. Demand is basically the ability to buy, the ability to demand for, to get something. That is demand. It's because you need that particular thing. That's why you want to get it. Because you need that thing, that's why you're doing what you are demanding for it. So demand is basically buying your interest in that particular thing. Because you have interest in it, that's why you want to demand for that particular asset. All right, so that's for demand. Supply is basically the ability to sell. When you are supplying, basically you are losing interest in in whatever assets you are supplying, you are losing interest in it, and that's what you're doing. What you're selling it up. And when you sell something, you are basically supplying that particular thing to what to other consumers or to other customers or to other people or to other market participants. So when you're selling off, you're basically supplying. All right. So demand is almost the same thing as buying because there's no way you can buy something without first of all demanding for it. You will first of all demand for that particular thing before moving on what to buy. That's why they say that demand is the ability to buy. There must be a demand before that buying action. The opposite goes for a supply. Supply deals with sell. All right. So with that said, how does this concept actually affect the market? So because we said that market mechanics is why price is moving, where price is moving from, where price is going to another. So how does this concept actually affect the market? That's what we want to discuss now. So just sharply, I'll just share my screen. So now let's talk about how does that supply and demand actually affects that particular business, the market itself. Now, you agree with me that it's assets that are being traded in the market. That basically the assets we use now, the activities and all that. They are the ones that are actually being traded. Now, it might not be the asset directly, but perhaps the currency that you are using in trading those assets, that's what is being traded over here. Take for instance, let's use the EURUSD for example. You're basically trading two currency. Yeah, trading one currency against the other. All right. And this currency is basically the currency that a lot of people use, especially when it comes to the US dollar. We use that US dollar very much. We use that US dollar what very much. So whether it's a currency, whether it's a stock, whether anything at all, it's basically an asset. All right, because it have monetary value. So it's basically an asset. The currencies as well, they are all what assets. All right. So with that being said, remember when you want to buy into an asset or when you want to demand for an asset, basically means that you are buying all this or that. So now, when there are people demanding, there are a lot of people demanding for a particular asset. That will increase the value of that asset because people have seen value in it. That's why they are demanding for it. And by doing so, it thereby means that since people are there, when a lot of people have seen more value in that particular thing, thereby increasing the value that thing have. Because once one person can see value in that particular asset, another person will also see value in that particular asset. The same thing with other people, and just like that, the value of that particular asset keep on increasing. And you see this price of a thing. This price of a thing is being determined by the value of that particular asset. Now, value then they give something price. If we don't value gold like that, gold will not suppose even near 1,000, talk less of $4,000 when they per this thing. If we don't value Bitcoin like that, Bitcoin suppose even near 10K those. It's because we value all these things. That's why we are demanding for them, thereby pushing price to the upside. Because once value increases, price will do what? Price will increase. And what will make value to increase is when people are demanding for that particular asset. So with that said, if the market is at this particular level and they are demanded for that particular market, what will happen? Price will move to the upside because I've just demanded. That means I'm interested in it. I've added value to that particular thing. And by doing so, remember, as value increases, price will do what? Price will increase. So whenever you see market pushing to the upside, it's because someone have added value to that particular what? To that particular asset. And that is why price is doing what? Is pushing to the upside. Now, the opposite goes for a supply. I want to sell something that I have. I'm not going to sell them unless I feel that that thing is of no use to me. It's of no value to me. And since it's of no value to me, that is why I'm doing what? I'm selling it. You don't get value, and I'm no longer interested in it. So I'm doing what? I'm selling up. I'm supplying it to others. By so doing, the value I once placed on that particular thing when I bought it, I've done what? I've removed that value from it, and that is why I'm doing what? That is why I'm selling it. By so doing, what will happen? That will lead to a drop in price because some people are no longer interested in that particular asset. Take, for instance, if there's crisis going on, let me say outbreak of wars and all that, what will happen? You will see Bitcoin falling because people during the time of crisis, people are not interested in the crypto market at such times. That means the value they once placed on crypto, they're not doing what? They're not removing it. And that's why you will see market falling drastically. So with this being said, demand have a positive relationship with price in which as demand increases, price will do what? Will increase based on what we are doing here. Whereas supply have a what? Supply have a negative relationship with price. The reason is simple. When people are supplying, the asset tends to lose value. And when people are demanding, the asset tends to what? To gain value. So this is basically market mechanics based on what? Based on the concepts of supply and demand. It's nothing much. It's just trying to say that with this, you should be able to understand that the reason why price is moving based on the concept of supply and demand is that if you see price moving to the upside, the reason why price will move to the upside is basically because there are people interested in that particular market. They are adding their values to that market, and that is why market is doing what is moving to the upside. Then, when you see market moving to the downside, you know that it's because people are no longer interested in that particular market, and because of that, that's why you see the market doing what's moving to the downside. That particular asset, they're no longer that interested in it. That's you know they feed, they go. That's why you see people doing what? Not being interested in such markets or in such assets, thereby leading to a what? If to drop in price. And this thing happen each and every time. It's not just a one day thing, it happens each and every what time in the market. That's why you see market, even if market like make it push come up, you go still do it, you go still come back. Because once market have traveled too far, people that have that asset, we feel like okay, market is now at an high price. And normally, if market dey on high price, it's more or less to almost to everyone, it's a tendency to do what? To sell. Because at that time you make more profit than selling at a lower price. And when you sell, remember when you sell, you are doing what? You are supplying off already. Thereby leading to a what? A drop in price. The opposite goes when market fall to a particular level and then you decide to because that's the lowest point. You feel like that's the lowest point that price we got to. That means price is basically at a discount, a very huge discount. So you decide to buy from there, pushing price to the upside. Why? Because you just added value to that particular asset or to that particular market. All right. So this is the explanation of market structure, market mechanics based on what? Based on the concept of supply and demand. Nothing much. Now, let's talk about based on the smart money concept. Now, please pay attention. The smart money concept is the most important one that you need because that's what you are going to be trading. You are going to be trading the SMC majorly. All right. So please pay attention to this one in particular. I'm going to actually re-explain this smart money concept again, probably in a better video just made for the smart money concept. But if I'm able to do so, well, I'm pretty sure I will do so regardless. So now, what is the smart money concept? Just like the name goes, smart money. Money when we say smart. Money can only be smart when it see that you, the owner of that money, use it smartly. So with that said, who are the smart money guys? The smart money guys are people who controls huge sum of money and know how to use it very well. Some of all these people include, or some of all these organizations include your big banks, them, and not just your big banks, your like all these fund institutions and all that, all these financial institutions, all these big ones, that they are the ones that actually do what hold huge sum of money. Now, based on market mechanics, we are made to understand that in the market, the type of move or the type of time to be trading in the market is when markets want to actually dish out a nice move, something like this. You don't want to be trading in this kind of market like that. You don't want to be trading in this kind of market. But you want to trade in this kind of what? You want to be trading in this kind of what? This kind of market. This big impulsive move, that's basically what you want to do, what you want to cash. And to do that, we make use of the words of the smart money concept. Now, remember, based on supply and demand, I think there's something I didn't mention. If you want to buy something, you will make use of money to buy. If you want to sell, someone else will be buying from you. So basically, money is involved. If you sell, after say you go sell at a lower price, money will be leaving that market. When you buy, money will be entering the market. But when you sell, money will be leaving the market, coming to you. But when you buy, money will be leaving you, entering the market. And that's why you see that whenever an huge or a large institution do what buys, the market will push to the upside. Because one of the major things I failed to mention during the concept of supply and demand is that money is what pushes the market. I can't believe I actually forget about that. Money is what actually push the market. When you demand, you are pumping money into the market. When you supply, you are removing money from the market. But don't be your small $10 share, that not the shake market. I'm talking about some but regardless, in the shake market to somewhat to some percentage. But they are the main people that can actually shake markets with just one move. These are the people that we regard as the what? As the smart money guys. And because of that, their big move, or we do what? We want to trade with them and do what? And follow them to cash such moves in the market. Like whenever they want to enter the market, we most likely want to follow them So I can be able to do it, can be able to catch that particular move that they want to initiate. So basically, what makes this smart money concept special is that your smart money guys, they control each sum of money. And since they control each sum of money, when they want to enter the market, that's where you will see the kind of moves that you really want. Take for instance, move like this is being caused by your what? By your smart money guys. Move like this is being caused by your what? By your smart money guys. So this is the type of market that I actually want to trade. This sweet market when we say index that many this thing does match TP. You don't want to trade in a ranging market like this. And because of that, we tend to use the smart money concept to do what? To try and cash all this trade because you see all this move is being initialized by the what? By the smart money guys. And since this move is being initialized by the smart money guys, you want to do what? You want to trade with them so I can be able to do what? So I can be able to cash sharp move like this. All right. That's why we most likely make use of the smart money concept so that I can be able to do what? Can be able to like follow your smart money guys to enter the market. Because now we cannot just make use of just the smart money concept, we have to add components and all that with some other stuffs as well, but we'll come to those ones later. But regardless, this is the explanation of market mechanics based on smart money concept. I know that this was not actually a detailed explanation, but we tried to make a proper video regarding this. It's already time for class. That's why. So that's for that. Now, I think what is the time? All right. By tomorrow, if tomorrow is going to be our next class, we're going to be talking about the various components of market mechanics. But basically, this what makes price to move. All right. Let's go over to some live example. Take for instance, move like how this one stand. All this sharp move like this one. It's been initiated by what? By your smart money guys. Move like all these ones that have been initiated by your smart money guys. So this sharp move. So this is what I mean when I say that we want to follow the smart money guy because this is the kind of move we actually want to do what want to cash in the market. Although this particular pair, I've not been that active in the USD. That's why you see as a empty. But all this move, I suppose not cash them, use their seed fronts. I'm not that active in USD. That's why. So yeah, it's basically all what you need to know for now regarding market mechanics based on smart money concept. So we usually used to add the two together, concept of supply and demand and the smart money concept to better explain everything well. All right. But this will be all for now. During the next class, we're going to be talking about the components of market mechanics. I'm kind of maybe to be sleepy right now, so my head is turning upside down. I won't be able to continue anymore for now. So, regardless, do you guys have any question regarding this class? Any question?
No, for me, I don't have any question for now.
All right. Anyone else have any question regarding to this class? All right, then, absence of no question, we end here for today.
Thank you. Thank you,
All right,
sir.
nice.